BizAd 136, Team 2, Team 1, Chapter 2, and Action.
So we're presenting on Chapter 2. My name's Nathaniel.
My name's Bronwyn.
My name's Drew.
My name's Cortland.
And this is on asset classes and financial instruments. It's basically just an overview of like what Chapter 2 is about, and like it kind of gives us a foundation of what's going on just in the book. So asset classes are separated by 3 different types of categories, which is fixed income, equity, and derivatives. And we're gonna, like right now, I'm gonna focus on the fixed income like subsector of it, which is money markets and capital markets. So the money market is like I said, a subsector of the fixed income market, and it's short term. It's highly liquid, which means like there's a lot of activity going through within the money market. It's low risk, and it often has large denominations, and like we're talking like 6 figures and greater. So the major components of the money market are federal funds, small denomination time deposits of saving deposits, which those are less than 100,000, and large denomination time deposits are greater than 100,000, treasury bills, commercial paper, and money market mutual funds. And we're talking like billions of dollars, as you can tell by the table. So money market securities. So what securities are tradable assets. So one of them are treasury bills, which are short-term debt of the U.S. government, and these are essentially lending money to the government and getting money back. So the government has this money, and they're going to give you like a maturity date, and once that maturity date passed, you could claim the money again, claim the money back with interest. So it's essentially you're giving out money to the government, and then you're getting money back. It's an investment. Certificates of deposit is kind of the same thing, but it's with banks. Again, it's a promissory note, and it also has a maturity date. You can't take it out. You can't take out this certificate of deposit. You can't take your money back until the maturity dates, until you reach the maturity date. If you do, like they'll tag you on like some sort of like fee. Like if you take it back out, you have to pay like a fraction of that price. So yeah, that's for banks. Commercial paper is short-term unsecured debt of a company, and that's like, for a company, it's like liabilities and accounts payable. Those are commercial papers. Bankers' acceptances is kind of like treasury bills and banker certificates of deposit, but it's a commercial transaction, so it's like more common through company to a bank. Eurodollars are time deposits for a foreign currency. Repos and reverses are, so a repo is a dealer sells government securities to investors. Usually it just happens overnight. It's a really short-term loan. And they buy them back the following day. And if you do that, if you are the dealer and you buy it, that's a reverse. Repo's the other way. Federal fund is a very short-term loan between banks. So that's like banks giving each other money. If like a bank runs out of specific currency, a bank could give federal funds to another bank, and that's what it is. So yields on money market instruments. Money market securities are not free of default risk. There's a lot of securities that are very low risk, but obviously nothing is like free of risk, and that's like shown through like the housing bubble and stuff like that. The premium on bank CDs and the TEV spread often become greater during periods of financial crisis. Yeah, that's self-explanatory.
Awesome. And so next we're going to continue on the capital market, which is the other subsector of the fixed income market. And so we're talking about the different like time periods that are going to be relevant here. And so we have long-term loans, which must be over 1 year, and then short-term under a year. And so the liquidity of assets is how quickly you're able to convert something to cash. And the capital market is low risk, but it's not as low risk as the money market. And so within this, there's a lot of like treasury notes and bonds that we're going to be discussing. And so these are typically like safer investments, and they will have like a lower rate of return. but they are guaranteed by the U.S. government, as you can see, and so that having that government backing is one of the reasons why a lot of people are more interested in going this way, even if they are going to get a lower rate of return. And for maturities, so notes and bonds, they have different maturities on them. So notes can mature within like 1, 3, 5, 7, or 10 years, and bonds typically have maturities over like 20 or 30 years, so it's a longer term investment. And so we wanted to just mention, so like par value being 1,000, interest is being paid semi-annually, so you will get that within like twice within the year, and quotes are the percentage of the par. And so securities within the capital market like vary between stocks and bonds, and so the inflation protected treasury bonds are what we refer to as the TIPS, and then there's also federal agency debt and international bonds, and there are like various names for this. And so then there's also municipal bonds that we'll be going into. And so these can be coming from like state government, local government, and one of the main draws is that interest is exempt from like federal tax, like income tax, and sometimes from state and local tax depending on where you're located. And so that's a big draw for people, because if you're not going to be taxed on that income, that's definitely a pro. And so there are two types. There's the general obligation bonds and revenue bonds, and they vary in like levels of risk and return. General obligation bonds tend to be less risky as they are backed by the government, and then revenue bonds just come from specific products, so it'll vary there. And then we just had a chart that we wanted to explain regarding the like distribution of tax exemption going in between general obligation bonds and the industrial revenue bonds. Oh no, just kidding, that's still me, my bad. Alright, so continuing, we have just like the okay, so we have comparables after tax returns on each bond, and so this is just like the formula that you would use when you're looking for the rate of return, and providing reasoning for why the municipal bond is preferred. And then this is another visual that we wanted to bring up for the reasoning for why certain things are like more tax exempt than others.
You can, let me do that really quick.
Okay.
So as you can see on the top, the marginal tax rate, sorry, at the bottom, the marginal tax rate. So as your marginal tax rate increases, and as the tax exempt yield increases, look at that part where it says 5%, 50%. So you can see at a 50% marginal tax rate and a 5% yield, you're really getting almost 10%. And at 1% tax exempt yield, at a 20% tax bracket, you're getting 1.25. So basically, obviously, as the yield goes up, but really as the tax rate goes up, you're getting a higher yield. And the Bay Area has the highest concentration of muni bond issuance in the United States. We have more people here that actually own muni bonds than almost any place else in the U.S. just because of the wealth, and people are buying those tax benefits.
Okay. And then the last part that we wanted to talk about was corporate bonds. And so these can be issued they are issued by private firms, and they have also semi-annual interest rates, as the last ones that we were talking about did, and so they are similar in that regard. There is a larger risk than government-issued bonds and securities, and there are options, and so we've like sort of gone into options already, but having the ability to opt to like in or out of like buying a certain thing at the date that you've discussed previously, it comes like at a cost, but having that option could also save you money in the long term. And so they have callable and convertible, options, and so that is allowing corporations to like repurchase bonds once rates have fallen, and so you can have corporations that will sell a bond at one rate and then buy it back at a lower rate and make money that way. And then convertible is when the holder of those bonds is able to convert it into various different shares of a common stock, and then you're getting a higher rate back on the cash value.
And then we're going to move into mortgage-backed securities. There's actually two types of mortgage-backed securities. We have pass-throughs, and the reason they're called pass-throughs is because with these, the mortgage payments are usually just collected and passed on to investors. And we have collateralized mortgage obligations, or also known as CMOs. With these, it consists of multiple pools of securities, known as slices or trenches. These slices are given credit ratings, and based on the rating is your rate of return. The more risk you take on, the higher return that you're going to receive, and vice versa. These are produced by securitizing mortgages in the U.S. These mortgage-backed securities played a role in the 2007 financial crisis. Fannie Mae and Freddie Mac were the hugest holders of these. So traditionally, with mortgage-backed securities, they're set up with conforming mortgages. Conforming meaning that you were at the right credit worthiness for your mortgage. Later, private label issuers also got in and started securitizing large amounts of subprime mortgages, where you weren't exactly at the right credit readiness for these mortgages, and they carried a lot more risk. Fannie and Freddie were allowed and even encouraged to buy these subprime mortgage securities, which is in part what led to our huge financial crisis. On this graph right here, it's showing that historically the feds have had the highest amount of outstanding mortgage-backed securities, also that it's increased substantially over the years, as well as for private issues it has also increased a pretty big amount over the years. And on this next slide, if you take a look, it's kind of hard, the colors are a little similar, but you'll notice that about a little less than a quarter of fixed income makes up the U.S. market. Now, moving on through asset classes, we're going to move on to equity, and that's going to consist of common stock, preferred stock, and ADRs, which are, I'm going to get into that. So common stock is ownership in a company. It gives you a little bit of residual claim. This means that you're actually really at the bottom of the ladder with common stock, so you're usually the last to get something. However, it does have limited liability, which means that the company's liabilities are not yours. You're not responsible for that. You're only responsible for what you put in. Then moving on to preferred stock. Preferred stock usually contains perpetuity. This is basically periodic payments that stop. These preferred stock doesn't usually have a maturity date, and will usually have redemption features. The dividends are fixed. You get priority over common. That means you're usually about second in the ladder, so that means you're usually going to get stuff a little sooner than most. As well as with preferred stock, you have better tax treatment. Earnings are taxed lower than normal when you earn on preferred stock. It's actually no tax if you're in the ordinary bracket, which is about 15% and below. Most people are in the 15% bracket, which has a little bit, and the highest bracket gets taxed the most, which is at 20%. Then, moving on from there, we have ADRs, which are American Depository Receipts. These are certificates that are traded in the U.S. markets, and they represent ownership in a foreign company. It's the most common way for someone in the U.S. to go ahead and branch out into somewhere foreign to potentially make some good money. These ADRs can be sponsored or unsponsored, meaning that when you're sponsored, you enter into agreement with the U.S. to handling or with the U.S. Depository Bank, sorry, to make plans for the necessary services required to, host this company in a sense. Unsponsored are set up without the cooperation of the foreign company. It's usually initiated by a broker-dealer trying to establish a trading market. There's also 3 levels to ADRs, level 1, 2, and 3, with 3 having being the most prestigious. You usually have public offering if you're level 3.
Okay, so now moving into stock basics. So first we have dividend yield, and the form is all posted. So it's yearly dividends over purchase price, and this is the annual dividend payment expressed as a percent of the stock price. So it's pretty much the percent return on dividends. Next we have capital gains and losses. So for gains, the share price exceeds the security price, and then for loss, the share price is lower than the security price. And then for price earning ratio, the equation is price earnings ratio equals price per share over earnings per share. It's the ratio of the stock's price to its earnings per share. So next, the stock market indexes. So we first have the Dow Jones Industrial Average, which includes 30 large blue chip corporations. In 1928, it only had 20 stocks. Just a little fun fact there. It has been computed since 1896, and it uses the price-weighted index, which is the investment in each company in the portfolio is proportional to the company's share price. And then you have the S&P 500, which is the broad-based index of 500 firms. It uses a market value weighted index, and it's proportional to outstanding market value. Okay, the next one is that investors can base their portfolios on an index. So they can buy an index mutual fund or buy exchange traded funds. And this is still native finance terms, but I'm pretty sure exchange traded funds, it's like a group of funds, right? And the index mutual fund is shares in proportion to their representation in a market index, and it yields a return equal to that of the index. And then the exchange traded funds is portfolio shares that can be bought or sold as a unit, and it's available. ETFs range from portfolio that track broad global markets to more narrow industrial industries. Okay, and then these are just some other indexes that we use, which is the New York Stock Exchange, NASDAQ, which we all know is more for tech companies and it's more volatile. The Wilshire 5000, wasn't completely sure about that one, but it's the ultimate U.S. equity index, and it computes market value of essentially all actively traded stocks in the U.S. And then to the right, we have foreign indexes from Japan, Germany, Hong Kong, Canada. I won't try to say them, I'm probably going to butcher them. But you have those. And the foreign ones use the Morgan Stanley Capital International Index, and it computes dozens of country indexes and several regional indexes. Moving on, we're moving into derivatives. A derivative is a security that gets its value from the value of another asset, such as commodity prices, bond and stock prices, or market index values. And the value derives from value of another asset. And then we move into options. This was still a little confusing for me, not gonna lie. So you have the call option, which is the right to buy underlying asset at the strike price, and strike price is interchangeable with exercise price, just a heads up. And the value of calls decrease as strike prices increases. And with calls and options, call options and put options, I'm pretty sure that there is a set time frame that you put.
3 months.
3 months.
Is the contract.
And it's like you have to buy before or on, and then you have a set price, which is the strike price that you
You can American options, you can exercise at any time during the option period, which is 3-month calendar. January, February, March, April, May, June, July, or September.
Oh, it's like quarterly.
It's quarterly,
Okay.
exactly. And you can exercise at any time. Those are the American options. European options, similar time periods, but they expire at the end. You can only exercise at the end of the contract period.
Thank you. And then put options are the right to sell underlying assets at the strike price, and the value of strike price, and that's inversely related to the call option. Both calls and puts increase with time until expiration, and like I said, it's interchangeable with exercise price, strike price. So next is futures. So it's an agreement made today regarding the delivery of an asset, or in some cases, its cash value, at a specified delivery or maturity date for an agreed upon price, called the futures price, to be paid at contract maturity. So this one you definitely pay at the end, when the contract matures.
The contract period goes out a certain time period, but the futures contract, you have to settle on a daily basis. So if you're in the money, you get money in your pocket. If you're out of the money, you gotta pay money out. That's the risk of trading futures contracts, is you have to have money, you have to pay out if you're losing on a daily at the end of the day, or you can pull money into your account at the end of the day if you're in the money. So you have to have experience, and you gotta have enough money to be able to pay out the losses if something happens. The futures contracts, let me give you a little note here. If I go long, let's say oil prices based on some oil index, but actually the oil index starts to fall, so it's going in the opposite direction. So I'm paying money out at the end of every day, so I'm bleeding to death, basically. What you would do is you would write a futures contract and cancel out the position. So anytime that the futures contract position goes against you, you would write the opposite side of the contract and close out the position. That's what's kind of cool about futures contracts.
And then the long position is taking delivery at maturity, and the short position is making delivery at maturity. And our last slide is the comparison. You have to tap it. Thank you. More. Okay, so the options and the calls and options, or the options, are the right but not obligation to buy or sell, as opposed to futures contracts, which you're obliged to make that delivery or take it. And the options exercise only when it is profitable, and in the long and short position, you must buy or sell at the futures price. So that one's, futures you have to do, options is optional, you have the right to do it. Options must be purchased, and the premium is the price of the option itself, whereas futures contracts are entered into without cost. So you have to pay to play, you don't have to pay to play.
A lot of people don't want to trade futures contracts, so what they'll do is they'll trade option contracts on futures prices based on the underlying indexes. So it's a derivative on a derivative.
That's it. That's all I have. Right.
So it's great.
That's
Thank
it.
you, everybody. So while the next team is getting set up, what I went around to do was to talk to everybody about their the progress that they're making in regards to putting together the portfolio strategy, your style. What is the portfolio that you're going to be constructing, that you're going to be pitching us on to develop and market that strategy. You can decide on what your strategy is going to be. Once you've decided really your return and risk tolerance, you then can determine the allocation of your portfolio by large cap, mid cap, and small cap stocks. Then you would want to come up with a sector allocation that would also be reflected in the return to risk that you've communicated. If you're defensive, you're probably going to have more defensive sectors. If you're going to be more aggressive, you're going to have more aggressive sectors. If you're defensive, they're going to probably be low beta stocks. If you're going to be aggressive, it's going to be high beta stocks. And then you start to, once you've kind of figured out those allocations, then you're going to allocate to those sector allocations and those market cap allocations the companies that meet those criteria. And then try to segment them by sectors within the spreadsheets. And then on Tuesday, I'm going to ask you to give me like a 1 minute, maybe a 2 minute elevator pitch on what it is you're constructing and what it is you're selling. And then start to pull up the spreadsheets and start to put some data in and start working with the spreadsheets to put together the portfolios. this is your first product. All right, thank you. I'm gonna go see what's going on. You guys,
Just looking for,
oh, looking for a room?
yeah.
Okay, cool. But they were looking for me.
Your phone ringing, I think.
Yeah, that's okay. Let's take it. I just wanna make sure it's not an emergency or something.
Okay, hello everyone. I'm Nick.
I'm Megan, and I'm Yuji.
Today we're going to be going over how securities are traded. A quick overview of like what we'll be talking about is just how firms issue securities, market transactions, the rise of electronic trading, globalization, the stock markets, and then market regulation. So the first part is just to recognize that there are two markets. There's a primary market and then there's a secondary market. So companies, they issue out stocks to gather funds. And when they're initially issuing out those stocks, we refer to that transaction taking place as the primary market. So that means that those specific stocks have just never been owned before by a person. And then the secondary market is basically like any trade that occurs after the primary one. And one reason why investors tend to do that is just to really diversify their portfolio. So companies start off all as small, and so they're kind of referred to as privately held firms. A little less than 500 shareholders generally. They have a lot of risk with them, and they want a lower liquidity of shares. And one way to expand their operations is actually just to issue out more stocks. So small companies tend to be referred to as privately held firms. Moving along, publicly traded companies. The definition is in like the phrase itself. Those are companies that trade with us, the investors, like the actual people. And they do this through a few ways, through IPOs and seasoned equity offerings. So initial public offering is the first issue of stock to that general public. And then when that happens, that company becomes public. So if it was private before, and it's the very first time they issue it publicly, they're now claimed to be public. And then seasoned equity offerings is basically when a company decides to like raise additional capital by selling additional shares of stock to the public. So they're already public and they just want to make more money. And so that's seasoned equity offering. Here's a good chart to kind of explain the relationship among a firm issuing securities and underwriters and the public. Kind of think of it like a org chart or an organizational chart. At the very top you have the issuing firm, then you have the lead underwriter, and then below them you have all the different investment bankers. A underwriter is a person or company that underwrites insurance risk. So we see this a lot in banks, insurance, and investment houses, like that particular sector. And one thing, an example of what could happen in this situation is the issuing firm gives the lead underwriter like $200,000, and to take off some of that risk from themselves, they might distribute that depending on like what the investment bankers specialize among each other. So just really working as a team, delegating tasks and whatnot. Okay, so how firms issue securities, the SEC Rule 415. Shares can be sold on short notice and in small amounts without incurring high inflation costs. And they do this by keeping shares in the inventory so it's easily acceptable. And the SEC Rule 415 stands for shelf registration. It's a type of public offering where certain issues are allowed to offer and sell securities to the public without a separate document for each act offering. So I kind of talked a little bit about this earlier, IPOs, initial public offerings. Roadshows that publicize the new offering just think of like promoting. They're going out trying to get a gauge as to like, are people interested into this? Like, what's the demand for these securities? And what are they gonna actually maybe sell it at when they launch it? So it's just kind of like the scouting report. And this is important because you don't want to undervalue or overvalue the risk. So let's say a company goes public at $20, but the market is actually able to support that price at $25. You are therefore undervaluing that IPO. And then the same would be if the market could only support $25 and then you're putting it at $30, you are overvaluing it, and then you're not going to be able to sell as much. So it's really important, the whole scouting report phase, to really get a gauge as to what the actual demand is and what people are actually able to pay. So Groupon, for example, was a company that underpriced their IPO, and then Facebook, when it came out, they were a company that overpriced their IPO.
And I'll just make a note, usually the investment bank will be incentivized to underprice the shares. They will do a firm commitment and take the whole issue. And then what will happen is they will issue the shares. They will buy the whole batch, and then when the company goes IPO and listed on the exchange, they will basically liquidate all of their positions. So not only does the investment bank make the underwriting fee, but since they took a firm commitment in all of the shares, if it's priced at 25, if the market demand is 25, but they priced it at 20, they're going to sell it at everything at 25. So usually the investment bank undervalues the shares to get at least another 20% on top of the fees. So they try to underprice the shares by at least 20%, so that when the shares are issued, they get a 20% pop on the return on the shares along with their fees. You have a lot of investment bankers.
So it's safer to undervalue.
Huh?
It's safer to undervalue versus overvalue.
Yeah, so they usually undervalue it by about 20% to get the 20% pop, because they bought the whole issue under a firm commitment. And then when the company goes live on the exchange, they start liquidating the positions, and they sell off the majority of their positions at 25, but they bought it at 20, so they made, you know, in most IPOs, they want to get at least 20% on top of their fees. There's a little principal agent problem there, and it's probably somewhat unethical, but the investment banks can pretty much do whatever they want.
So moving on, types of markets. I read somewhere where like the main type of markets are brokerage markets and dealer markets. So broker markets are like contacting clients to sell like certain shares, or telling them to buy these shares that the brokerage firm may have in inventory. And then dealer markets kind of like work like a retail store, where they look at the inventory on the shelf, and it's either like you're going to buy that inventory or you're going to offer to sell that inventory to a dealer in the future.
The brokers are just take buyers and sellers and batch them up. The dealers actually hold an inventory in the stock. So if the stock gets overpriced, they sell off the inventory to bring the share price down back into an orderly market. If the price drops too far, then they start buying up the shares to basically set a floor underneath the price of the shares. So they're making a market in between the range and allowing for an orderly market, and not having the prices get overbought, oversold. Okay.
And then lastly, the auction markets. Traders converge at one place to trade, so like the New York Stock Exchange. Bid and ask prices, sort of the opposite of each other. Bid prices, they offer to buy. Ask prices, they offer their sell offers. Basically, so if the dealer is buying a stock, this is likely they're going to be buying inventory to sell it later. That's a bid. And then for ask, this is why you have to pay. This is what you have to pay when you want to buy that specific security. And then bid-ask spread is the profit from making a market in a security, and they're not fixed. So like depending on how many securities you want to buy at a time, you might have like a different pricing Am I saying that right?
The,
So
the,
for
bid- the bid-ask spread, which is the profit, usually thinly traded securities have very wide bid-ask spreads, but very large companies with lots of supply and demand, the competition to make a market in their securities puts pressure and compresses the bid-ask spread. The
Exactly.
larger, more liquid they are, the narrower the spread, the more illiquid, smaller, riskier the firms are, the wider the spread. So the market maker is gonna want more profit to take more risk. You know, and then the lower the risk, the lower the bid-ask spread, the margins.
Yeah. And then moving on, there are market orders and price contingent orders. Market orders are executed immediately, so whatever the price is at that time, that's the price it's going to be traded at. And then price contingent orders, traders specify buying or selling prices. So basically they can say like when certain stocks get to a certain price, like they raise up at this certain price, or if they raise down at this certain price, then they initiate at the beginning, like that's when we have to trade it. And then this is kind of like more, these are the more technical terms of like different types of price contingent orders, like the stop buy order, the stop loss order. Orders if they're placed above the price and price keeps going up is stop buy, and then like a sell limit is order placed above the price and the price then goes down. And this is an example of like the bid ask and the pricing size for Facebook.
You want some water?
Got it. So, trading mechanisms, so dealer markets are,
Could you speak up a little bit?
dealer markets, are traded on over-the-counter markets. They require direct negotiation after finding the best trading opportunity. They've transitioned from automatic quotation systems from pink sheets to automatic quotation systems to the present day NASDAQ stock market. Electronic communication networks, or ECNs, allow participants to post and limit orders over computer networks. The limit order is a book available to all participants. It offers anonymity in trading. It's the system that determines if there's a matching order, and they can, the computer system can facilitate by finding a buyer and a seller, offer. And specialist markets were replaced by ECNs, but they're on exchanges such as the New York stock market. They assign responsibility for managing trading in each security to a specialist or brokers who act on their behalf. Specialists maintain the limit order book of outstanding unexecuted limit orders. And maintain a fair and orderly market to manage the prices and narrow the bid-ask spread. The rise of electronic trading. So in 1975, there was elimination of the fixed commissions on the New York Stock Exchange, and in 1994, the new order handling rules on NASDAQ led to narrower bid-ask spreads. And then in 1997, reduction of minimum tick size from 1/8 to 1/16. And in 2000, in the US, the share of electronic trading rose from 16% to 80%. And also in 2000, the emergence of the NASDAQ stock market happened. And then the year following, in 2001,
there was a reduction of minimum risk tick size from 1/16 to 1 cent. In 2006, the New York Stock Exchange renamed to NYSE ARCA after acquiring the electronic Archipelago Exchange. In 2007, there was a creation of the National Market Systems, or the NMS, to link exchanges electronically.
And then how many more slides do you have? Okay, we're gonna have to, you're gonna have to continue on Tuesday, because I wanna get through the problems.
Okay.
Because they're not gonna wanna put the problems back up on the board on Tuesday. So why don't we, finish it off on Tuesday? Okay, and then let's see if we can burn through the problems in 40 minutes. Okay, so who's gonna go first?
I'm number 10, if you just want. Should we just go that way?
Yeah, let's just go around like that. So you may want to get queued up if you're going next. Thank you very much. Sorry. Action.
Alright, so I did number 10. In the textbook it says turn to figure 2.8 and look at the listing for General Dynamics. If you have the textbook.
And please speak up when you're doing your presentations. It's hard to hear.
Turn to figure 2.8. So for the first question, it's asking how many shares could you buy for $5,000. I just did the math right here. So yeah, for that $5,000, each share costs $142.97. If you do the actual math, that would equal 34.97 shares, but it's impossible to trade in fractions, so it'll only be 34 shares of General Dynamics. Then letter B asks, what would be your annual dividend income for those shares? So I did the math right here, so 34 times $3.04 is equal to $103.36. Moving on to C, what must be General Dynamics earnings per share? So 13.39, and the price is $142.97, therefore $142.97 equal 30. I did a lot of quick hands here. Sorry about that. Right. Therefore, $142.97 earnings per share is equal to $15.39, which is then broken down into $9.29. And then letter D, going back to the question, is what was the firm's closing price on the day before its listing? And then General Dynamics closed today at $142.97, which was actually 47 cents lower than yesterday's price of $143.44. So just refer to the graphic I told you to look at, and this would all make a lot more sense.
Thank you.
Okay, so I did chapter 2, and I did number 4. What would happen to the spread between yields on commercial paper and treasury bills if the economy were to be in a recession? And what would happen is that there would be a very high risk, and a lot of companies would charge higher premiums on the securities and probably also default on them. And for number 5, it asks you to explain the key differences between corporate bonds, preferred stocks, and common stocks. In common stocks, you have voting rights and perpetual payments, and in terms of liquidity, it would be third. And for corporate bonds, you have a contractual obligation, and they also have fixed payments, and they're also first on the liquidity list. And preferred stock, you also have perpetual payments. You have accumulated dividends and also fixed payments, and they'd be second on the pecking order in terms of liquidity. And that's it.
Great, nice job.
Alright, I did chapter 2, number 8 and 9. The question for number 8 was, suppose investors can earn a return of 2% for 6 months on a treasury note with 6 months remaining until maturity. What price would you expect a 6-month maturity treasury bill to sell for? So treasury bills are discount securities that mature for $10,000, therefore
yield price is simply the maturity value divided by 1 plus the semi-annual return rate, which would be 10,000 divided by 1.02, which equals $9,803.92. And then for number 9, the question was find the after-tax return to a corporation that buys a share of preferred stock at $40, sells it at year end at 40. Let's write that wrong. Or sells it year end at $40 and receives a $4 a year end dividend. The firm is in the 30% tax bracket. So the total before tax income is $4 after the 70% exclusion for preferred stock. Dividends, the taxable income is 0.3 times $4 equals $1.20. Therefore, taxes are 0.3 times $1.20, which equals 36 cents. And the after-tax income is $4 minus 36 cents, which equals $3.64. And the rate of return is $3.64 over $40, which is 9.1%.
So chapter 3, question 10 is you are bearish on telecom and decide to sell short 100 shares in the current market price of $50 per share. So A is how much cash or securities must you put into your brokerage account if the broker's initial margin requirement is 50% of the value of the short position. So 50% of the short position is 100 shares times $50 a share is 5,000, so 50% of the 5,000 is 2,500. And then B is how high can the price of the stock go before you get a margin call if the maintenance margin is 30% of the value of the short position. So here's the equation you set up, and you gotta isolate P, so you're gonna multiply 100 to this side and get 30P equals 7,500 minus 100P. Subtract the 100P over 130P equals 7,500. Multiply the 130P to that side, and the price can't get higher than $57.69.
For chapter 2, question 6, the question is why are high tax bracket investors more inclined to invest in municipal bond than low bracket investors? And the answer is municipal bond interest is tax exempt at the federal level and possibly state level as well. And for higher marginal tax rate, high income investors would be more inclined to invest in tax exempt securities. And for number 7, so there's a chart on page 2.3, or for chapter 2.3, and look at the treasury bond maturing in November 2041. How much would you have to pay to purchase one of these bonds? And you have to pay at a risk price of 161.2% of par value of $1,000, which is $1,611.87. And what is the coupon rate? And the coupon rate is 6.25, implying coupon payments of $62.50 annually, or more precisely, $31.25 semi-annually. And what is the yield to maturity of the bond? And the yield to maturity on fixed income securities, also known as a required return, and is reported by Wall Street Journal and others in the financial press as the ask yield. In this case, the yield to maturity is 2.113%. An investor buying the security and holding it until it matures will earn an annual return of 2.113%.
Alright, so this is chapter 3, number 8. This is a limit buy order and then limit sell order table. The first question is, if a market buy order for 100 shares comes in, what price will it be filled? So you're looking to buy, we have to go through what we sell, which people are looking or willing to sell at, so it'd be $50.25. And then the next question is, what would be the next price? Since you already bought 100 shares, there's no longer any available at that price, so you have to go to the next price, which is $51.50. And the final part C is your security dealer. What would you, or would you want to increase or decrease the inventory of the stock? You would want to increase your inventory. There's considerable buying demand at prices just below 50, indicating low risk. And then in contrast, limit sell orders are sparse, indicating that a moderate buy order could result in a substantial price increase.
So I did chapter 2, number 5, and the question is, the coupon rate on a tax exempt bond is 5.6%,
And can you speak up a little bit? Thank you.
and the rate on a taxable bond is 8%. Both bonds sell par at what tax bracket the marginal tax rate would an investor be indifferent between the two bonds? So since the after-tax yields are equal, I made them to equal, and then this is the formula, and you have to isolate the t, so if you do all that, the answer is 30%.
Alright, so we had chapter 3, questions 1, 3, and 4. So for the first one, the question was, what are the differences among stop loss order, limit sell order, and market order? So for the stop loss, it allows stock to be sold if the prices fall, and that's often seen in short sales. The limit sell allows stock to be sold if the prices rise. And the market order, you can buy or sell at the current market price.
The third question is, how do margin trades magnify both the upside potential and the downside risk of an investment position? And the answer was leveraging borrowed money allows for greater return on investment if stock price increases. And the other answer is, if stock price declines, investor must pay the loan regardless of how far the price has dropped.
And the last one, number 4, was a multiple choice question. So it asked, a market order has what? And it was A, price uncertainty but not execution uncertainty.
I have chapter 2, number 11, and the question is calculate the rate of return on a price-weighted index of the 3 stocks for the first period. T equals 0 to T equals 1. So at T equals 0, the value of the index is 90 plus 50 plus 100 divided by 3, which is 80. And at T equals 1, you do 95 plus 45 plus 110 divided by 3, and that's 83.333. So you divide those and subtract 1, and you get your percent of 4.17. And for B, it was what must happen to the divisor for the price of the weighted stock of the price weighted index in year 2. And so stock C would sell at 110 and the value of the index is 83.3 with a divisor of 3. After the split, stock C sells for 55 and the divisor of D, so you do 83.333 equals 95 plus 55 divided by D, and D equals 2.340. And for C, calculate the rate of return for the second period. T equals 1 to T equals 2. The rate of return is 0 and the index remains unchanged because of the return of each stock separately.
I did chapter 2, problem number 18. For A, it's regarding owning the call option, which gives you the right but not the obligation to buy at $180. However, the stock price is, or the stock is trading in the secondary market at a price of $193. You will, since the stock price exceeds the exercise price, you will exercise the call. The payoff option, you get that by taking the price that the stock's selling at in the secondary market and subtracting that by the price that you can buy the stock option or the option at. And that gives you a price of, or that gives you $13. And then to find the cost was originally $12.58. To find the profit, what you do is you take the payoff option and then subtract that by the original cost, and then you get 42 cents. For part B, since the stock price is greater than the exercise price, you will exercise the call. The payoff option, again, you take $193 and then subtract it by $185, you get $8. Then the option originally cost $9.75. So like up here, to find the profit, you take the payoff option and subtract it by the original cost, which is which ends up being negative $1.75. For part C, owning the put option gives you the right but not the obligation to sell at $185. But it could sell on the secondary market for $193. Since the stock price is greater than the exercise price, you will not exercise the put. And so to find the loss on the put, it will be the initial cost of $12.01.
Nice job.
I did chapter 4, problem 10. It's basically just a question about what the formula for the turnover rate. So it stated that value of stock sold and replaced was $15 million. And then the turnover rate is basically the value of stocks. And this was also given, so it's 15 million divided by 42 million, and it was 35.7%.
Then I had chapter 1 questions, number 9 and 10. In number 9, we're given 2 balance sheets, one for a financial institution and one for a non-financial institution. We're asked to find the ratio of real assets to total assets for each. In A, we find the ratio for real assets to total assets, so you do real assets over total assets, and you'll get your ratio. This is for the financial institutions. This is for the non-financial institutions. In C, it asks why the non-financial institution has a higher ratio than the financial institution. But what it comes down to is that financial institutions find the bulk of their business in loans. And although loans are assets to them, they're not real assets. Whereas non-financial institutions, for the bulk of them, is investing in equipment, manufacturing plants, property. These are all real assets. They have value due to the substance and physical properties. So the reason why the non-financial institution has a higher ratio is because they have more physical substance in a sense. For number 12, the question was oversight by large institutional investors or creditors is one mechanism to reduce agency problems. Why don't individual investors in the firm have the same incentive to keep an eye on management? This came down really to cost versus benefit. For an individual investor, the cost usually outweighs the benefit. Suppose you have $10,000 stock in Volkswagen and you're an individual investor and you set a kind of ambitious goal to increase it by 5%. That would net you about $500 gain, but look at the loss on your personal time as well as any costs you incurred. Chances are that loss is gonna offset that gain. However, for a bank who has probably a huge multi-million-dollar loan outstanding to a firm, they have a huge stake in this firm, meaning that the cost does not outweigh the benefits usually.
Alright, so I did chapter 1, numbers 3 and 4. And so the question for 3 was, what is the relationship between securitization and financial intermediaries in the economy? And then what happens to financial intermediaries as securitization progresses? And so securitization does lead to disintermediation, and that's because it provides a means for market participants to bypass intermediaries, so somebody who would be helping them with the whole deal. And so, for example, mortgage-backed securities channel funds to the housing market without requiring banks or thrift institutions to make loans from their portfolios. And so it works well and can benefit a lot, but only if the securities are highly liquid. And so as securitization progresses, financial intermediaries lose those opportunities and they have to find other ways to generate revenue. So that'll be providing short-term liquidity to consumers and small businesses. And then for number 4, the question was, how would the productive capacity of the US economy be affected if there were not markets to trade financial assets. And so, like, the general gist of this is that the existence of efficient capital markets and liquid trading of financial assets makes it easier for large firms to raise the capital that they need in order to finance like all of the investments that they're doing, because it's in real assets. And then they gave an example, so like if Ford, the car company, couldn't issue like stocks or bonds to the general public, then they'd have like a much harder time raising capital. And so being able to contract financial assets would make financing more difficult, and it would therefore like increase the cost of capital. And a higher cost of capital results in less investment, and so it'd be lower real growth.
Okay, I had chapter 1, problem number 8, and it kind of piggybacks off of number 7 for the values, because the values were all given in number 7. But it pretty much asks you to prepare a balance sheet just after this company gets the bank loan, an A. So you wouldn't use cash when computing it because it's financial asset, but computers are real assets because you're using the ratio of real assets to total assets, and computers are physical assets. So you have $30,000, and then the total assets was $100,000. So you do 30,000, divide that by $100,000, so you get the ratio, which is 0.3. And you wouldn't use liabilities at all because we're not looking at liabilities, only assets. And B, it told you to prepare the balance sheet for when they spend $70,000 to develop the software product. So software product is a physical asset, so it's a real asset, and computers are still a physical asset. So you would take $100,000, which is the total of the two, divide that by the total assets, which is still $100,000 to get 1 for your ratio. And then for C, you prepare the balance sheet after the company accepts payment of shares from Microsoft. So you have Microsoft shares under assets, which are financial assets, since they're not a physical asset, so you wouldn't use those. You would cancel the $120,000, and you would just compute the $30,000 over the total of $150,000, because computers are still a physical asset. And over here is $30,000 over $150,000, and it's 0.2 for the ratio of real assets to total assets. And as you can see, like as the company starts, like the ratio is pretty low. As they're fully booming, it's high, and as they're shutting down, it's low again.
Nice job.
Chapter 2, question 12. Calculate the first period rates of return on the following indexes of the stocks. A, market value weighted index.
Total market value at T equals 0 is 9,000 plus 10,000 plus 20,000 equals 39,000. Total market value at
T equals 1 is 9,500 plus 9,000 plus 22,000 equals 40,500. Rate of return equals 40,500 divided by 39,000 minus 1 equals 3.85%. Part B, the return on each stock is A equals 95 divided by 90 minus 1 equals 0.0556. B equals 45 divided by 50 minus 1 equals negative 0.10. C equals 110 divided by 100 minus 1 equals 0.10. The equally weighted average is 0.0556 plus negative 0.10 plus 0.10 divided by 3 equals 0.0185, which is 1.85%. Question 13. An investor is in a 30% tax bracket. If corporate bonds offer 9% yields, what must municipals offer for the investor to refer them to corporate bonds? The after-tax yield on the corporate bond is 0.09 times 1 minus 0.30 equals 0.063 equals 6.30%. Therefore, municipals must offer a yield to maturity of at least 6.30%.
So I had chapter 3, the first question from the CFA, and the first question was about like finding the total cost of underwriting, and in addition to the explicit fees of $70,000, FBN appears to have paid an implicit price in underwriting for the IPO. B, underpricing is $3 per share, or a total of $300,000, implying a total cost of $3,700. $370,000. And the second question was about the costs corresponding to underwriting, and the answer is no. The underwriters do not capture the part of the cost corresponding to the underwriting. The underwriting may be a rational marketing strategy. Without it, the underwriters would need to spend more resources in order to place the issue with the public. The underwriters would then need to charge higher explicit fees to the issuing firm. The issuing firm may be just as well off paying the implicit issuance costs represented by the underpricing.
So I did, this is 19, but I actually did question number 15 from chapter 1, and it was basically just asking the advantages and disadvantages of top-down versus bottom-up investing. I kind of think of top-down as big picture and bottom-up as like detailed small picture per se. So for top-down, you focus on asset allocation or broad composition of the entire portfolio. And that really like lets you establish a portfolio with a level of risk consistent with your risk tolerance. But the disadvantage of that is that you forfeit potential high returns. Bottom-down strategy, on the other hand, you really identify the undervalued securities. But the disadvantage of that is that you might not have a diversified portfolio. And it's going to require a lot of active management because you're really like nitpicking at things. And so the way I kind of like understood it was like for top down, you start from the top. So you first look at like the health of the economy, and if that's good, then you're going to go to the industry, so like technology. And then after that, you're going to go to the earnings. And then once you can check all those things off, then you're going to buy it. Now the bottom up strategy would be the exact opposite. You're going to start with the earnings. If that's good, you're going to check it. Then you're going to go to the industry, and then you're going to go to the health of the economy. So more just like macro, micro, big picture, small picture. And that's top down, bottom up strategy.
Great, thank you. Okay, so we have a little extra time, so we're going to resume where we left off on the presentation and spend the next 20 minutes seeing how far we get on this chapter. Oh, we do?
Yeah.
Oh, I thought we went to 250. Okay, great. Then we're done. I'm sorry, I didn't mean to make you do that.